Hello everyone, welcome back to our channel. Today we have an exciting topic to dive into.
You know, so many people think trading support and resistance is some kind of sixth sense, a gut feeling you're either born with or you're not. But what if I told you it's not some mysterious art? It's a workflow. It's a structured, repeatable process that anyone can learn. So today, let's build that workflow together, right now. This, right here, is the question that really separates traders who make it from those who don't. I mean, we've all been there, right? Making those emotional, gut-wrenching trades that have no real plan and usually end up costing us. Today, we're going to replace that chaos with a simple, 5-step rule-based plan.
So here's our roadmap. We're going to build this thing together, step by step. We'll start with the foundation and work our way all the way up to the most important part, our non-negotiable exit rule.
All right, first things first. Before you even think about drawing a line or placing a trade, you have got to understand the bigger story the market is telling you.
Think about it. A 15-minute chart might look like it's about to blast off to the moon, but if you don't zoom out, you might not see that it's about to smack its head on a massive wall of resistance on the daily chart. That context changes everything, doesn't it? That's why we always start with multi-timeframe analysis.
And here's the thing to remember. The support level on a daily chart is a completely different animal than the support on an hourly chart. You have to identify and respect the key levels on every time frame you're looking at, because they all add a piece to that bigger puzzle.
Okay, on to a fundamental mindset shift that is going to save you so much frustration. We are going to stop thinking in terms of exact, perfect prices.
You know the old way, right? You draw a perfect razor-thin line at, say, $100. But the market is messy. It's never that clean. It might dip to $99.80 or spike to 120 cents. By drawing a zone, a small box around that $100 area, you give yourself some breathing room. It's flexible, it's forgiving, and it accounts for all that real-world market noise.
So a zone is really just an area, a range where you expect a reaction. It's not a single line in the sand. Think of it more like a battlefield where the buyers and sellers are going to duke it out. Honestly, thinking this way is a total game changer.
Okay, so you've seen the big picture. You've drawn your zones. Now for a super critical step that most new traders just skip, planning your exit for a profit before you even get into the trade.
I absolutely love this metaphor. It's so simple but so powerful. If you're selling at a resistance level, a ceiling, where's the most logical place for the price to fall to? Well, the last place it found support, right? Its most recent floor.
So let's make that a concrete rule. Step 1, you find your resistance zone. Step 2, you look to the left on your chart and find that last significant low point. Step 3, boom, that low becomes your profit target. It's simple, it's repeatable, and it's based on what the market has actually done.
And that's the real key here. You're not just picking a random number out of thin air or hoping for some massive home run. You're setting a logical, high-probability target based on where the market has found support before. You're taking the guesswork right out of the equation.
All right, we are getting really close to execution now. You've done the analysis, you've got your plan. But this next step, this is where discipline really comes into play. It's all about patience.
So many traders see the price getting close to their zone and they just jump the gun. They get a feeling that it's going to work, but a plan is absolutely worthless without a clear signal. You have to wait for the market to prove that your analysis was correct.
This is the million-dollar question, isn't it? We see prices spike above resistance all the time, just for a second, only to come crashing right back down. So how do we filter out all that noise and know when a real breakout is happening? Here is your definitive rule. Ignore the wicks, those frantic, spiky parts of the candle. They're just noise. The only thing that matters is where the body of the candlestick closes. A close above your resistance zone or below your support zone, that is your signal. That is a valid breach. Anything else is just the market trying to fake you out.
And finally, we've arrived at the most important rule of all. This is the one that keeps you in the game. This is your ultimate defense mechanism, protecting your capital when you are wrong.
So let's say you're in a trade. You're expecting your support zone to hold, but then you see it. A full candlestick closes decisively below your zone. Your entire thesis for the trade has just been proven invalid. So what do?
No hesitation, no hoping it'll come back, no second guessing. Your plan had a specific condition for failure. That condition has now been met, and you execute the final part of your plan. You exit immediately.
And you should really see this not as a failure, but as a success. You successfully executed your risk management plan. You've just activated your pre-planned, non-negotiable escape route, and you've preserved your capital to trade another day.
And there you have it. That's the entire workflow, from high-level analysis all the way down to precise execution. Look at the big picture, draw flexible zones, set a logical target, wait for that valid candlestick close, and have a non-negotiable exit if you're wrong.
This is where the real work begins. See, having a plan is one thing, but having the discipline to follow it every single time without letting emotion get in the way, that's what trading is all about. The rules are right here, but the execution, well, that's on you.
இந்த வீடியோ உங்களுக்கு பிடிச்சிருந்ததுன்னா லைக் பண்ணுங்க, ஷேர் பண்ணுங்க, சப்ஸ்கிரைப் பண்ணுங்க. Thank you for watching.